Hi there, welcome back to Dukascopy TV. I'm Ben Jones. Finnish GDP was released today, and on the line I have Danielle Haralambous from the Economist Intelligence Unit to discuss the current slump and the impact of the Russian slowdown. So Danielle, if we can talk initially about the GDP figures released today, on an annual basis the growth rate is minus 0.8%, so the figure's still negative and it has been for the previous 7 months. What's the reason for this negative growth?
This negative growth really reflects weakness in exports at the beginning of the year. It's the loss of Russian demand, weak euro area demand. Exports were 1.9% lower on the quarter, 3% down on the year. And I mean, this weak demand environment has also meant subdued business confidence, which is damaging prospects for business investment, which continues to contract. That's still down 5% on the year. Although it didn't contract quite as much on the quarter as we thought it would have done. So, it's potentially not as bad as we thought it was going to be. Private consumption was actually a bit of a bright point because it grew 1.1% on the quarter. But we still expect consumer demand to be fairly sluggish this year because the government's austerity package focuses on welfare spending and consumption taxes. And so we only expect consumption to actually grow about 0.5% over the whole year. But yes, so it was overall reflective of weak international demand.
Now, the economy of Finland has been described as being on a razor's edge, with some expecting a third year of recession. What can be done, in your opinion, to improve the current state of the economy?
Well, the most significant short-term risk to the economy this year is the slowdown in Russia. Finnish companies are really exposed to that. So one thing they could do is seek to find other export markets. They're already selling quite a lot to Sweden, where growth is expected to be quite firm. But Eurozone demand is also expected to pick up. But Finnish companies could perhaps find other export markets to sell to. Perhaps more of a long-term plan would be reform of the labour market. In Finland, unit labour costs are still higher than the euro area average, quite significantly higher. And that's considered to be a limiting factor for foreign direct investment flows. The problem is that I don't think the government's going to do anything to address an issue like that, particularly, which will require quite a big new policy initiative until after the election, because relations within the coalition are quite fragile.
Finally, can you elaborate on how the slowdown in Russia is affecting Finland's economy, and what could the potential damaging effects be if the situation continues to worsen?
Well, again, it's really demand conditions. 14% of Finnish exports went to Russia in 2013, and historically it's been about 10 to 15% of Finnish exports selling to that market, and Finnish companies in particular are exposed to it. The problem is that if demand weakens considerably in Russia, which it's likely to, it will affect the Finnish economy from that direction. There's also the tourism trade, which will be affected. Russian consumers are going to have their personal disposable income eroded by high inflation this year, which means that the influx of Russian tourists to Finland is going to fall further than it did in 2013. The risk is that the government's debt ratio rises if growth is slower. Also, if demand in the economy undermines tax receipts, the public debt to GDP ratio is already likely to peak above the EU's limit of 60% next year. If it goes any higher than that, then there'll be some real questions about what the government needs to do to bring it down to protect Finland's AAA credit rating.
Danielle, thank you very much for sharing your insight with us today. That's all we've got time for now. Kiri Bloor will be covering the all-important ECB announcement later today, and I'll be back tomorrow with your weekly wrap-up, so make sure you keep clicking back. Bye for now.